Welcome back to the channel, everyone. Today, we're diving into one of the most crucial and misunderstood concepts in the financial world, working capital management. Whether you run a small business, manage a startup, or simply want to understand how companies stay financially healthy, this video is for you. This is part 1 and 2nd series. In this first part, we'll focus on what working capital is, why it matters, and how companies manage it smartly, without any complicated calculations. Let's get started. Section 1. What is working capital? So, what exactly is working capital? In simple terms, working capital is the money a business needs to run its day-to-day operations. Think about paying employees, buying raw materials, stocking inventory, paying electricity bills, and keeping the lights on. All these activities require cash that flows in and out constantly. Working capital is made up of two main things. Current assets, things a company owns and can quickly turn into cash. Examples: cash, accounts receivable, inventory. Current liabilities, things a company owes and must pay soon. Examples: supplier bills, short-term loans, salaries. If current assets are more than current liabilities, a company has positive working capital. That's usually a good sign. Section 2. Why working capital management matters. Now here's the important part. Just having working capital isn't enough. Companies must manage it effectively. Why? Because businesses don't fail just from losses, they fail from running out of cash. Imagine a company sells a lot and looks profitable on paper. But if customers don't pay on time, and the company still has to pay suppliers, salaries, and rent, boom, cash crunch. That's why working capital management is all about. Ensuring there's enough liquidity, avoiding financial bottlenecks, and keeping the company running smoothly every single day. Good working capital management leads to smooth operations, better supplier relationships, higher profitability, reduced short-term debt, faster growth. Poor management leads to delayed payments, frustrated suppliers, inventory pileups, borrowing at high interest, even bankruptcy. Working capital might sound small, but it can make or break a business. Section 3. Components of working capital. 1. Cash management. Cash is the heart of working capital. Cash management ensures a company has the right amount, not too much and not too little. Too little cash, you can't pay bills. Too much cash, you are losing opportunities to invest. 2. Inventory management. Inventory is tricky. Hold too much, and your money gets stuck on shelves. Hold too little, and you disappoint customers. Companies must find the sweet spot, enough inventory to meet demand without wastage or storage overload. 3. Accounts receivable management. This is money owed to the company by customers. If customers pay late, your cash flow suffers. Smart companies offer early payment discounts, follow-up reminders, credit checks, anything to make sure money comes in on time. 4. Accounts payable management. This is money the company owes to suppliers. Good working capital management means pay on time, but take advantage of credit periods and build strong supplier relationships. Section 4. Real-life example. Let's say you run a small business selling t-shirts. You buy materials from suppliers, produce shirts, sell them to retailers, and wait for payment. Here's how working capital comes into play. Cash to buy raw materials. Inventory sitting in your factory waiting to be sold. Receivables from retailers who bought but haven't paid yet. Payables that you owe to your fabric suppliers. If your retailers take 60 days to pay you, but your suppliers want payment in 30 days, you have a working capital gap. And guess what? That gap has to be filled with cash, either your own or borrowed. That's why smart working capital management keeps the timing of cash inflow and outflow aligned. Section 5. Strategies for effective working capital management. 1. Speed up receivables. Offer early payment discounts. Send invoices immediately. Follow up politely. Use digital payment systems. 2. Improve inventory turnover. Use demand forecasting. Avoid overstocking. Implement just-in-time practices where possible. 3. Optimize payables. Use full credit period. Negotiate better terms. Maintain good supplier relationships. Maintain a cash buffer. Keep emergency funds. Don't depend heavily on short-term loans. 5. Use technology. Inventory management software, automated billing, real-time cash monitoring tools. By applying these strategies, companies can keep their finances tight, reduce stress, and improve profitability without even increasing sales. And that wraps up part 1 of our working capital management series. If you found this helpful, hit that like button, subscribe, and drop your questions in the comments. This is part 2 of our working capital management series. In part 1, we understood what working capital is and why it's so important. Now we're going deeper. We'll explore the working capital cycle, advanced strategies, real-life examples from well-known companies, and best practices you can apply to any business. Section 1. What is the working capital cycle? The working capital cycle shows how long it takes for a company to turn cash into products, sell those products, collect cash from customers, and then pay suppliers. In simple words, cash gives inventory, gives sales, gives receivables, gives cash again. The shorter the cycle, the better the company's cash flow. A long cycle means the company waits too long for money to come back in. A short cycle means money moves quickly through the business. Let me give you an example. A company buys materials on day 1, turns them into finished products by day 10, sells them on day 20, customers pay on day 35. If suppliers allow 30 days of credit, this company has only 5 days where its own money is tied up. That's efficient. Companies work hard to reduce this cycle because shorter cycles equals stronger cash flow equals higher profits. SECTION 2. Techniques to shorten the working capital cycle. 1. Reduce inventory holding time. Holding inventory for long periods is like keeping cash locked in a closet. Companies shorten this by using demand forecasting software, producing in smaller batches, switching to faster suppliers, clearing slow-moving stock with discounts. 2. Speed up receivable collection. Money on paper is not money in the bank. Businesses shorten collection time by offering small cash discounts, requiring partial upfront payments, using automated invoicing, evaluating customer credit history, charging late fees politely. 3. Improve supplier credit terms. A good relationship with suppliers can do wonders. Companies negotiate longer payment terms, flexible delivery schedules, bulk order discounts, extended credit for loyal customers. This allows them to hold onto cash longer while still keeping suppliers happy. 4. Using technology to speed up processes. Technology is a game changer in working capital management. From AI-driven inventory tools to digital payment platforms, companies use ERP systems, real-time cash dashboards, inventory tracking, online credit control tools. These tools prevent delays, reduce waste, and help managers make faster decisions. Section 3. Case study. How big companies manage working capital. 1. Walmart. Low inventory, high efficiency. Walmart is famous for keeping incredibly low inventory levels while still offering thousands of products. How do they do it? Massive data analysis, accurate demand forecasting, close integration with suppliers, just-in-time delivery systems. This keeps their working capital needs very low, freeing cash for expansion. 2. Amazon. The negative working capital model. Amazon is even more interesting. They often receive money from customers before they pay their suppliers. This creates negative working capital, and it's actually a good thing here. It means Amazon uses supplier credit to fund operations. Customers pay instantly, but suppliers may get paid in 30, 60, or even 90 days. Result: no cash strain, strong liquidity, money available for growth and innovation. 3. Apple. Cash-rich strategy. Apple keeps a large cash reserve, one of the biggest in the world. This allows them to negotiate better supplier contracts, avoid short-term loans, invest in new technologies, survive market downturns easily. Their strong working capital position supports long-term stability. 4. Small business example. Local grocery store. Even small businesses use working capital strategies. A grocery store restocks fast-moving items daily, keeps very little old inventory, and pays suppliers weekly or monthly. This helps them run lean, reduce spoilage, and keep cash flowing. Section 4. Mistakes businesses make in working capital management. Let's talk about the common mistakes companies make. 1. Keeping too much inventory. Stocking excess goods ties up cash and leads to waste. 2. Offering credit to unreliable customers. If customers don't pay, your business suffers. 3. Paying suppliers too fast. Many companies pay earlier than needed and end up short on cash. 4. Borrowing too often. Short-term loans can trap companies in debt. 5. Not forecasting cash needs. A business can be profitable and still fail due to poor cash planning. Section 5. Best practices for strong working capital management. Maintain optimal inventory. Not too high, not too low, just enough. Clear credit policies. Who gets credit? For how long? On what conditions? Monitor cash flow weekly. Cash flow is the oxygen of your business. Build strong supplier relationships. Good terms equals better cash control. Use automation. Reduce delays, human errors, and lost invoices. Keep a cash buffer. Always prepare for emergencies. Thanks for watching the complete series on working capital management. If you found this helpful, don't forget to like, share, and subscribe for more financial education content. Drop your questions in the comments. I reply to all of them. See you in the next video.